In this lecture, we're going to begin one of my favorite topics in all of financial accounting, leases. But before we touch a single journal entry, I want to tell you a story. The story of how leasing became the biggest off-balance sheet loophole in accounting, and how the rules finally caught up. The history of leasing in business is a familiar tale. Companies were looking for ways to improve their financial performance using only the numbers. But understanding why companies lease and why the accounting rules for lease transactions were necessary will help the mechanics of the journal entries make more sense, because every one of them exists for a reason. I like to start the story of leasing in the airline industry, mostly because planes are big and expensive, and it's easy to understand how accounting for planes could make a big difference in the financial statements rather than a delivery truck or a copy machine. The story begins in the early 70s when you could pull up the balance sheet of a major airline, a company whose entire business is flying airplanes, and find almost no airplanes on it. Hundreds of jets in the air, painted with the company's logo, flown by the company's pilots, and the balance sheet showed practically nothing. No aircraft assets. And more importantly, no liabilities for the billions of dollars of payments that the airline was contractually committed to make. So where did all the airplanes go? Well, they were leased. And under the old accounting rules, a carefully structured lease meant that the airplane and the debt that paid for it simply never showed up on the balance sheet. As you know, we use the balance sheet to assess the riskiness of an investment. Does the company have enough assets to pay off their debt? But if a significant portion of the assets and liabilities are being left off the balance sheet entirely, how can we make sense of the company's financial position at all? Are they a risky investment or not? And that's the puzzle we're going to unravel this week. To be fair to leasing, companies have perfectly good business reasons to lease instead of buy. It's not all nefarious just to make the numbers look better. Leasing offers the equivalent of 100% financing, no down payment, and the payments are spread over the time that you actually use the asset. So leasing also offers flexibility. If you're worried that technology is going to be obsolete in 5 years, a 5-year lease lets you hand the asset back and walk away. The obsolescence risk stays with the lessor. But there was also a third reason, and this was the one that kept accountants and regulators up at night. Under the old rules, leasing could keep the financing arrangement entirely off the balance sheet. You got the asset, you committed to years of payments, economically identical to borrowing money and buying the thing, but the liability never appeared. That's what we call off-balance sheet financing. Much like leasing office space, companies like Delta Airlines were simply recording rent expense for the airplanes that they were leasing, most likely from Boeing. So if Delta leases their planes from Boeing, then they don't technically own the planes. But the plane has Delta's logo painted on the side, only Delta uses it, and they're probably going to use it until it's not good anymore. So don't they own it? And another important detail, the lease payments that they're making over the life of the lease, if we were to add them all up and take the present value, they'd equal the price tag of the plane today. That really seems like they bought the plane. Of course, regulatory agencies like the SEC weren't fooled, and in 1976, the FASB finally passed some accounting rules that required companies like Delta to record an asset and a related liability for a lease transaction that was so much like a sale, it must have been a sale. Under these rules, leases came in two flavors. A capital lease, one that looked enough like a purchase, went on the balance sheet, asset and liability. An operating lease did not. The only accounting for an operating lease was to record rent expense as payments were made. Nothing on the balance sheet at all. Unfortunately, there was still a problem. The line between the two was drawn with bright line tests. For example, the rules said that any lease that was greater than 75% of the asset's useful life should be considered a capital lease. I'm sure you're not surprised at all to hear that anything with a bright line rule like that invites some engineering, creative accounting, if you will. Companies would structure a lease to fail the capital lease test by just a hair, a lease term of 74% of the asset's life instead of 75. And poof, billions of dollars of payment obligations vanished from the balance sheet. Same airplane, same payments, completely different financial statements. Think about what this meant to the people trying to use those financial statements. An investor comparing two airlines, one that borrowed its fleet and one that leased its fleet, would see two wildly different balance sheets for two economically similar businesses. The leasing airline looked almost debt-free. Its debt ratios looked great. Its return on assets looked spectacular because the assets weren't even on the books. The distortion was so severe that analysts stopped trusting the balance sheet altogether. They would take the lease commitments from the footnotes and manually rebuild the balance sheet, adding the leases back in. Stop and think about what that means. The market was already treating these leases as debt. The only place that they weren't debt was in the official financial statements. When your financial statements are the last place to reflect economic reality, something is wrong, badly wrong, and the regulators agreed. It took a really long time, 40 years actually, but the FASB finally rewrote the rules. The current standard is called ASC 842, and it's built on a simple idea called the right of use model. When you sign a lease, you acquire something real, the right to use an asset for a period of time, and you take on something real, an obligation to make payments. So we record both, a right of use asset and a lease liability, each measured at the present value of the lease payments. And here's the key change. This applies to essentially all leases, not just the ones that look like purchases. Under the new rules, we use the term finance lease instead of capital lease. But whether the lease is a finance lease or an operating lease, the asset and the liability still go on the balance sheet. The distinction between the two types of leases still matters a bit because it changes what the income statement looks like. And we'll spend the rest of the week on exactly that. But the days of the invisible lease are over. Let's make the distortion concrete. Here we have a company with $1 million of assets and $600,000 of liabilities, which means $400,000 of equity. They need a $4,000 machine. We're going to build the balance sheet two ways. First, we'll assume the company borrows the money and buys the machine. Second, we're going to assume that the company signs an old rules operating lease for the exact same machine. And then we'll compute the debt to assets ratio both ways just to see how different the same company can look. Okay, let's build this company's balance sheet. They have assets of $1 million. And of those assets, 600,000 can be claimed by creditors, which means the other 400,000 can be claimed by the owners for a total of $1 million in claims on the resources. Our resources of $1 million can be claimed by these two different groups. So the first calculation that we'll do is debt to assets. And what this tells us is just how much of those assets, of the resources, can be claimed by creditors. And we've got 60% right now. Another useful metric is debt to equity. And this is a useful metric of risk because it shows us the relative claim to resources that belong to creditors versus the owners of the company. So for every dollar of ownership, how much is owed to others? And if we take 600 divided by 400, we get 1.5. You usually want to see that number be lower than 1, right? Because you want your liabilities to be lower than the ownership interests in the company. So now if this company buys an asset, but under the old leasing rules, it would be an operating lease and not change the balance sheet position at all. But if they were to buy it normally by borrowing money, so we'd add $400,000 to the liabilities, and then they would have a new asset of $400,000. This would be their financial position. They would have 1.4 million in assets. They'd have 1 million in liabilities and still 400,000 in equity for a total of 1.4. So looking at the ratios again, debt to assets here becomes the 1 million divided by 1.4. So it becomes 71%, right? And that's the 1 million divided by 1.4. And debt to equity becomes the 1 million divided by 400,000. So we get 2.5. So those are pretty big increases. We go from 60% to 71% is debt to assets, and 1.5 to 2.5, which is a really traditional measure of risk, has more than, not almost doubled. So that's a big deal. To wrap up, companies lease for real business reasons, 100% financing and flexibility. But for decades, the biggest attraction was that operating leases stayed off the balance sheet. That practice distorted the financial position of major corporations so badly that analysts were rebuilding balance sheets by hand, and the regulators finally ended it. Under the new rules, ASC 842, a lease puts a right of use asset and a lease liability on the balance sheet, measured at the present value of the payments. Next up, we're going to look at the classification rules that decide which kind of lease we actually have.